And we are back at it again here at Clever Markets, now starting into a new year 2024. I hope you all had a great break. I certainly did. I just spent some time at home in Singapore with my loved ones, and I was pretty boring on Chris. No, wait, on New Year's Eve. I even went to bed before midnight, so I'm that boring actually. Okay, so we are starting the year with the TTF as we do every single week. And while we were away, the markets have developed exactly as expected. So now I have updated the arrows. And the expectations are for the market to move just slightly higher in the next couple of days and weeks. Why do we believe that? That's because we did have this hammer forming here, and the hammer is usually a bullish signal. We had it confirmed with a bullish stochastic signal. For those who want to wait it out a little bit, we would probably be a little bit more careful and wait until we get a break above 20, which is the oversold territory. So here's the thing. We do have a bullish setup, but there is no confirmation yet. So what we want to see with a hammer, for example, we want to see a close above the hammer for it to be confirmed if you want to be a little bit slower. Also, a move above the 23.6% FIB at 36.18 is needed to turn this noise into an actual upside correction. But here the idea is later we'll see on the daily chart that we might be moving higher a little bit. So that's why we think, okay, a little bit higher, probably into this resistance area, maybe even this gap that we had here at 38.11. Yeah, so this little gap here. So somewhere in this area, we might find some strong resistance. We also have the 8 and 12 exponential moving averages here. So all of this is offering resistance. But if we break above this zone, then we could very easily make it to 46.14. Why that? Well, that's because it is also the 61.8% FIB retracement, which is where most steeper corrections actually peak out. Overall, the market is looking a little bit bullish. So zooming out, like looking at the long term, we see we are making higher lows and we are making higher highs. So overall, yeah, the market is gradually moving higher. Let's see, can we even connect it? I think there you go. So we could even put this here on. So we do see that overall the idea is for the market to move higher. What I like to do as soon as I have a line drawn, I like to copy that and see if it makes sense to draw in a channel. We can see it doesn't really make much sense. So you can put it here. So we have these 2 points meeting, but we don't have anything here. So it's a little bit weird. If you go all the way up here, then this here doesn't seem to matter anymore. So that's why at this point in time, I do not believe that adding this line would provide us an edge in trading. So that's why I don't do it. So here we do see probably a little bit higher, and then the market has to make a decision. But for now, with information available to us, it still looks like we would eventually move lower. Why that? Because we did get a bearish signal on the MACD, so it's still moving lower. And also we see that the 8 and 12 exponential moving averages on the weekly chart are still pointing lower. But this can change, right? So we need to observe these and we will adjust our thinking about the market if we break above this range here. And if we then make it to 61.8, then we would, of course, these tools would, of course, shift as well. So for now, a little bit higher, then we need to see with information available to us, possibly a little bit lower thereafter. So first a little bit higher we say, okay, so what does that mean? We could, on the daily chart, we could probably make it to the 37 area, which is where the channel resistance is hitting us. So I'm zooming out a little bit, we can see we are in this downtrend, and now we are correcting higher. We did have a bullish signal on the stochastic, and we can see that the MACD also started making higher lows and higher highs when the market was still moving lower. So this is called bullish divergence, market moving lower, tool moving higher. So that simply means that the bears are exhausted. So I don't believe that we'll see any significant downside in the next coming sessions. But you can see overall, we are still below the Ichimoku cloud, so what's happening right now is still just a little bit of a correction, possibly towards 37. What happens at 37 has yet to be decided, so if we continue lower, I honestly believe that we might get a little bit of a sideways range between 30 and, I don't know, like 37, yeah, wherever we hit this. Because the bears are not in it anymore, the bulls are not winning, so possibly then a sideways range, if this level here is rejected. If we break higher, then yeah, possibly we could make it all the way to 41 or even beyond that. And can you see where that works out with the weekly chart, right? So we have 36 and then we've got like the 41 somewhere around in this area. So that's why it's so important to analyze the markets top down, but to trade bottom up, because in the bottom, from the lower level time frames, they usually start moving the earliest. So, but what does that mean for this morning? Well, I don't see the market to move higher significantly. I think we have topped out here. We do see that the MACD is moving lower, we have the stochastic moving lower, and we are very likely making it to this trend line here, and we might even break lower. That seems the most likely. And this line also coincides with the intraday Ichimoku cloud, so a break below that would be quite good for the bears. But we need to see what happens at this point when it happens. And that is all for the TTF. We are now looking at Brent front month. Okay, we see that on the weekly chart, we are still, or have been for quite some time, since, winter 2021, we have been moving into this increasingly tighter range, which is called a triangle. And that kind of means that the market is being driven into this apex here right now. So triangles in themselves, they have no inherent breakout direction, so they're not more predispositioned to break higher or to break lower. But what we can do is we can assess volume distribution within the triangle to get an idea of where we might be going. So let's have a look, because sometimes it is not that obvious and sometimes there simply isn't a preference. So let's zoom in. So over the most recent up leg, volume has been, so I'm looking at this and at this at the same time. So volume has been rising as the market moves up. And the white line is simply the average over the past 20 sessions. But then volume overall remains reasonably strong. We do have the occasional drop in volume, but we do see that as the market is declining, so is volume. So that kind of means that the market is voting, and it is voting for an eventual breakout direction to the upside. But that is not clear yet. Okay, so we had last week, that was a hammer candle, just as we had it a couple of weeks ago as well. And the hammer is usually a sign of bullishness, but it is unconfirmed. So what we really need is a break above 79.41, which is the high of this hammer. And if we break above it, then we could make our way to 84.75 or maybe even the upper triangle boundary near 90 eventually, 88 maybe. If this here is never triggered, then probably a little bit of a sideways trend. Then would make sense for us for the sideways market to move in this range here, which is 72.29 and 82.07. So somewhere in this range it's then the idea if resistance holds and support holds as well. So what are the tools saying? So we are overall still bearish. Stochastic, however, shows near-term bullishness, and momentum seems to be bottoming out a little bit at least. So it is a dangerous situation. I wouldn't really trade off. I mean, nobody is trading off the weekly chart. For that, we would have to move into the daily chart. Here we see that the market has been dominated since October by this descending channel, right? And it did work out quite nicely. But now for the first time in a long time, we started making our first higher low. So that's a sign for the bulls, but we are not in the clear yet. So what we actually need to see is a break above the channel near 80 or even if you want to be very sure, a break above 81.72, which is the high from the 26th of December. Because for an uptrend to be confirmed, we need higher lows, okay, and also higher highs. And the first higher high we would have at this point, and then we would see the market move higher. If the trend channel holds, then probably we are going to retrace lower and move sideways within the range of wherever the peak is here and the trough F74.79, so something like this. And can you see how that corroborates with what is happening on the weekly chart? We get a bullish indication. We need a break above 79.52, which is near the 80 of the trend channel. So a move above this area, 79, 80, would actually trigger a more sustained up leg. And what is happening this morning? So we are now looking at the 15-minute chart, and of course 15-minute charts only give us an outlook over the next couple of hours, so the start of the session. And here, I'm just putting this aside, we are also in a triangle. So the market is neutral here as well on the 15-minute chart. And with the evidence available to us, higher troughs on the stochastic and also a bullish MACD, and we would suggest, this would suggest eventual upside continuation. Here also we see volume is rising on the up legs and it is falling and on the down legs. So overall this means that, yeah, probably upside resolution seems most likely. So what happens after that? Well, I got this here. So we are measuring triangle targets. So just did this for visual ease. So please do use a real calculator. We always use the trough and the peak of the triangle pattern. By textbook, they're going to tell you that you have to use the widest point, like so, yeah. So you are measuring this distance, but I think this rarely works out and is not very much related to reality. So that's why I always like to move one in. So I measure this distance, and if we indeed break higher, then we would we would add this value to the upside breakout direction, and we would get a target near 82. And can you see, if we were to break lower, which seems much less likely, then we could make it all the way to 75. So this is how I like to work with triangles. Right now, I would not trade myself as long as we are within the 78.41 and 79.26 range. There's only losses to be had here. You can also see the market has nearly flatlined. But this is a really good setup for the start of the week. All right, let's move over to the next contract. We are now looking at European carbon emission certificates, and on the weekly chart we see that we are still within the descending channel, so it's all looking good for the bears in the midterm. And we did probably top out here. We did get a bearish engulfing candle, but what is happening here, it was not confirmed by a bearish stochastic. So what does that mean? Well, probably a little bit of a sideways move. So be careful either within the broad 68.55, 81.25 range, or if we find support at the lower channel boundary, then the range will be even tighter, near 72 and 81.25. So I do expect something like this for the next coming sessions. Because the bearish engulfing simply wasn't confirmed. Volume was above average, so that was good. But overall, I don't expect too many losses here. On the daily chart, what is happening? What is happening there? It looks a little bit different overall. And there you go. We see, zooming out, we are within the descending channel overall, but here we are in a very, very tight range of 74.59 and 78.29. A slightly wider range would be the candle from the 2nd of January, where the upper end is at 81.25. So I expect price to move within this range for quite at the start of this week. And then even if we move a little bit further, the sideways trend would still be maintained for now. Tools give us no clear signals. So we see that stochastic didn't even move into oversold territory. It's kind of flatlining, as is the MACD, as are shorter term moving averages. So let's have a look at something a little bit more medium term. So putting on the Ichimoku cloud, we see, yes, overall downtrend, true, but we also see that the lines have flatlined and the cloud is moving sideways. So here the expectation is for the sideways trend to continue for now on the near-term daily chart. And intraday, we have an even tighter range going on. So we are here on the 15-minute chart, and we ended last Friday in this really tight range of what is this, 75.99, 76.71. And the market is expected to move sideways for a little bit, and the market should eventually resolve to the downside, and that is because the stochastic is making new lows. At the moment, we don't pay too much attention to the MACD or to moving averages, but the stochastic overall moving lower, forming lower lows and lower highs, that would assume that we get an eventual break lower. And that is all for European carbon emission certificates.